Although the stock market sell-off of 2022 showed signs of receding, they are still having huge discounts this year. The good part is that if the stock market gets worse, savvy investors with an eye for long-term gains can still find opportunities to buy some great companies at cheap prices. Hey, welcome to Stock Market Mate. In today's video, we'll discuss some discounted stocks that you need to buy now. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. Now let's look at some of those potential long-term stocks that investors should think about buying amid the stock market sell-off. Number 5. Amazon. Due to the dramatic decrease in IT stocks this year, investors can now purchase certain well-known brands at affordable pricing. Amazon, for example, is currently trading at 56 times earnings as compared to its 5-year average earnings multiple of 122. Last year, Amazon was trading at 65 times earnings, so the 30% slide in stock prices made it relatively affordable. Investors may not want to miss this opportunity to buy Amazon as the company is on track to take advantage of multiple catalysts. For instance, the tech giant controls a third of the global cloud infrastructure service market that was worth $178 billion at the end of 2021. Second place Microsoft was well behind with a 21% share, indicating that Amazon is strongly positioned to take advantage of the huge opportunity in this space. With the cloud computing market expected to clock annual growth of nearly 18% through 2028, Amazon could witness solid incremental revenue growth from this segment. Throw in Amazon's prospects in the global e-commerce market, and it becomes easy to see why the company's earnings are expected to grow at an annual rate of 40% for the next 5 years. All this makes Amazon a top tech stock to buy right now. Number 4. Tesla. Sales of electric vehicles are taking off, and Tesla is already taking advantage of this massive opportunity. This is evident from Tesla's performance in the first quarter of 2022. The company recorded an impressive 81% year-over-year growth in revenue to $18.8 billion. Thanks to a nice spike in vehicle deliveries and production. Tesla had produced just over 305,000 vehicles during the quarter, a 69% decrease over the prior year period. The company's delivery shot up 68% year-over-year to 310,000 vehicles. What's more, Tesla's adjusted earnings before interest, taxes, depreciation, and amortization were up 9 percentage points over the prior year period to 26.8% last quarter, driven by solid growth in deliveries, higher average selling prices, and lower production costs per vehicle. Tesla is now looking to ramp up its manufacturing capacity. Its factory in Austin, Texas is already online, while the Texas Gigafactory is expected to start producing Model Ys later this year. The company's factory in Germany has also gone online. In all, Tesla aims to grow its annual vehicle deliveries by an average of 50% over the long run, with the global EV market expected to clock annual growth of 29% through the end of the decade. It won't be surprising to see Tesla hit its ambitious growth target in the long run. Not surprisingly, analysts are expecting nearly 43% annual earnings growth from Tesla from the next 5 years, with Tesla stock losing 30% of its value in 2022 and trading at 13.4 times sales as compared to last year's sales multiple of 25.6. Now looks like a good time to buy this potential growth stock on the cheap following its crash. Number 3. Qualcomm. Qualcomm is a tech giant that's available on the cheap right now. Trading at just 13 times earnings, the chip giant is way cheaper than its 5-year average earnings multiple of 27. Analysts are expecting Qualcomm's earnings to grow at an annual pace of over 14% for the next 5 years. But it won't be surprising to see it clock faster growth thanks to the secular growth opportunity in smartphones, as well as the automotive and the Internet of Things markets where it's gaining traction. In the second quarter of fiscal 2022, Qualcomm's revenue had shot up 41% year-over-year to $11.1 billion. Smartphones accounted for a huge chunk of the top line at $6.3 billion, with the segment's revenue jumping 56% year-over-year. With Qualcomm controlling 30% of the global smartphone application processor market in the first quarter, thanks to stronger adoption of its chips by the likes of Samsung, the company is in a solid position to benefit from the adoption of 5G smartphones. Third-party estimates forecast that the 5G smartphone market could grow at nearly 130% a year through 2027, and Qualcomm's healthy share indicates that it could win big from this massive growth. Meanwhile, Qualcomm has design wins worth $16 billion in the automotive space, which should start translating into revenue once customers who have selected its chips start making vehicles and components using its chips. This point toward a massive growth opportunity as the automotive business had generated just $339 million in revenue last quarter, which was an increase of 41% over the year-ago period. Number 2. PayPal. PayPal was one of the first tech stocks to get crushed in the current sell-off after it released a disappointing 2022 outlook on its fourth quarter earnings report. There's no other way to look at it. Things are slowing down. That's not terribly surprising after it posted its best quarters ever in the early stages of the pandemic. Macro trends are shifting at a rapid pace, and PayPal did a complete turn from being at a peak to now slowing down. The reason to buy isn't just for its cheap price, but that's a big factor. PayPal stock is trading at its lowest valuation ever at only 24 times trailing 12 months earnings and a price-to-earnings growth ratio of less than 1, which suggests that the stock is undervalued at the current price. But the cheap valuation is meaningless unless the company is going to continue growing, and that's why PayPal looks compelling right now. It's likely to post lower growth with rising inflation rates and slower spending, but e-commerce, the company's bread and butter, is still increasing. PayPal is well positioned to take a big bite out of that for many years. The 2022 first quarter was far from a letdown. Total payment volume increased 13% year over year, and revenue increased 7%. One caveat is that, in 2021, PayPal ended its deal with eBay to provide payment services on its site, and so taking that out, revenue grew 15%. That was on top of a 31% increase last year, the company's strongest first quarter ever. PayPal stock is down 61% this year, and it may stay low until the economy is in better shape, but you don't have to wait for the stock to get any lower to lock in this deal. Number 1. Starbucks. For starters, Starbucks possesses a powerful competitive advantage that is intangible in nature, making it extremely difficult or impossible for a rival to replicate. I'm talking about the company's globally recognized brand. According to Piper Sandler's Spring 2022 Talking Stock with Teens survey, Starbucks was in the top 3 in the restaurant category among the Gen Z demographic. This is a lucrative spot to be in because these younger consumers have the potential to be lifelong Starbucks customers. Starbucks' gross margin of 27.9% over the trailing 12-month period indicates consumers' propensity to pay up for what they deem is a premium food and beverage product. A margin this high gives the business leeway when it comes to absorbing higher input costs while still maintaining profitability. Legendary investor Warren Buffett thinks that the most telling sign of a quality enterprise is the presence of pricing power. Starbucks checks the box in this category. A larger store footprint will allow the company to leverage its expenses as revenue rises, thus supporting greater levels of profitability over time. Coffee is a lucrative business to be in because it is universally loved and lends itself to repeat purchase behavior, which puts Starbucks in an advantageous position. With the stock's decline in 2022, shares are trading hands at a compelling price-to-earnings ratio of just over 20. Not only is this near the lowest level that Starbucks has sold for in the past decade, but the stock is also at a slight discount to the S&P 500's PE ratio of 21. Given the strong brand and growth opportunity, a valid argument can be made that Starbucks is a better business than the average company out there, warranting a higher valuation than the S&P 500. Well, that's about everything. Hopefully this guide will help you in your journey towards investing in 2022. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!